That is exactly what Burry believes is coming. Let's simplify this. Imagine a company buys $1 million worth of Nvidia chips. Instead of recording that full cost immediately, accounting rules let the company spread that cost out across the expected lifetime of the chips. That is depreciation. If the chips last 5 years, you spread the cost over 5 years. But what if, in reality, the chips only produce economic value for 3 years before becoming obsolete? If a company still uses a 5 or 6 year depreciation schedule, it is overstating its profits for years and will eventually be forced to report a massive impairment charge. That is exactly what Burry believes is coming. Here are the facts. Meta extended server life from 4 years to 4.5, then to 5, and now to 5.5 years. Google extended server life to 6 years. Amazon extended to 6 years and then slightly backtracked to 5. Microsoft and Oracle made similar adjustments. Every extension lowers expenses and raises reported profits today. Meta alone added more than $2 billion of extra profit this year simply by changing the depreciation schedule. Amazon boosted first quarter profits by $900 million after its change. So yes, companies are absolutely pushing depreciation further out. Burry argues that AI chips have extremely short competitive lifespans. If Nvidia releases a chip twice as fast as the previous generation, the old chips instantly become economically obsolete. They may still function, but they no longer create real economic value. If hyperscalers depreciate these assets over 6 years, but the chips become uncompetitive after 3, all of these companies will eventually be forced to take enormous write-downs. Burry points to Baidu as a real example. Baidu extended depreciation twice, boosting profits. Then they were forced to take a 16 billion yuan impairment because their older hardware was suddenly useless. If that pattern hits Google, Meta or Amazon, the numbers will be far larger.